Hey Bowtie Nation, Joseph Hogue here with a video I've been putting together for a long time. We do a lot of analysis here on the channel looking for those stocks to buy, but the 7 stocks I'm going to reveal today are my highest conviction investments. In fact, I feel so strongly about these 7 stocks, I've invested over $250,000 in my own portfolio.
What did you just say?
These are all deep discount stocks with potential returns that could double your money or more. I'll show you why I like each, a price forecast, and how much I've invested, as well as a warning that you need to hear. We're getting started, but before we do, you know I've got to send that special shout out to all you out there in the nation. Thank you for spending a part of your day to be here. If you're not part of that community yet, just click that little red subscribe button. It's free and you'll never miss an episode. I also want to personally invite you to get the Weekly Bowtie, our free weekly newsletter with all the stock market news, strategies, and trends you need to know. Each week before the market opens, I'll show you what I'm watching and the stocks that could highlight the week. It's all totally free, just something I like to do for all you out there in the community, so look for that sign up link below. Let's get into that list of stocks to buy, but stick around because later I'll show you how to invest in a stock that's falling without losing all your money, and a warning that every investor needs to hear right now. First on our list, one of my favorite growth stocks, SoFi Technologies, ticker SOFI, and this was actually one of the few growth stocks to move higher on its recent earnings report, but of course hasn't been able to kick that overall pull of a lower market and has dropped since. Now, that's important though, because besides what I'm going to show you about the stock later, the fact that it was able to move higher on those earnings, especially when so many other growth stocks have tumbled 20 or even 30% on those quarterly reports, it says investors still like what they're hearing from the company and are still positive on these shares. SoFi started as an online student loan platform, but has evolved into that full-service fintech digital wallet, and I believe this is one of the best positioned for the future of digital banking. Now, where other fintech platforms like PayPal and Upstart are still trying to bring on those products and services, SoFi already has a lead in everything finance, from insurance to credit, investing, and even banking. And a big part of this was the company's approval for a banking charter through its acquisition of Golden Pacific Bancorp that closed earlier this year. And because most of these other fintech companies don't have that bank charter, that license yet, they can't offer services like checking or savings, and they don't have access to those lower rates like a traditional bank. This really does put SoFi way ahead of the competition, and until the machines take over, the company is going to be leveraging that for real growth. SoFi reported 87% growth in new members last quarter to almost 3.5 million, and while the percentage increases is slowing, that's still amazing growth at that scale. To put that into perspective, the company's closest competitor, Ally Financial, grew its customer base by just 11.7% last year. SoFi grew revenue by 63% last year to over $1 billion, and more importantly here, became earnings positive on an EBITDA basis with $30 million in earnings before interest, taxes, and depreciation. And so this is something else that really separates it among growth stocks. You're seeing those biggest sell-offs and those growth stocks that, while they're producing some strong revenue growth are still losing money. They're still posting those negative earnings. Now, in comparison, the best growth stocks are the ones like SoFi that are now becoming profitable, where the stock price isn't still based on a hope of someday posting those positive earnings. Management has guided to 55% growth in revenue this year to nearly $1.6 billion and a 6-fold increase in adjusted earnings. But what is really powerful here is take a look at that change in the EBITDA margin from 3% in 2021 to a projected 11% this year. Now, that margin is the profitability, the amount of earnings as a percentage of sales, so how efficient the management is converting those sales into profits. Nation, this is one of the biggest things you need to be watching for in your growth stocks, those that can continue to grow their sales by 30 or 40% and more, while at the same time becoming more profitable. Now, that is a powerful trend. At one point, this stock traded for over $25 a share and over 25 times on a price-to-sales basis. Now it's down under $10 a share and trading for a price of just 7.2 times its sales. So if you do just some simple back-of-the-envelope math, analysts expect sales to continue at a 30% pace to $3.6 billion through 2024. Even if that price multiple comes down to 5 times sales, which would be extremely low for a company still growing its sales by 30% a year, but even at that, this would be an $18 billion company for a share price of $22.50 each by that time. And like a lot of the growth stocks we'll talk about, I think this one over the next decade goes well beyond that. As more of our financial lives go online, SoFi is going to be there and could grow into a mega bank. I started buying the shares this year, once in January and again in February, for a cost basis of $10.74 and just under $27,000 invested in this stock. Now you're going to notice I've bought most of these in multiple blocks, but I'm not just buying every time the price falls. So I wanted to outline a strategy for when to add to a stock without catching that falling knife all the way down lower. If I am buying a stock and it's around some expected event, like an earnings release or major news, a lot of the times I'll use half of the money that I was going to invest. That still puts me in a position to benefit if that stock jumps, but also sets some money aside to get in at a lower price if the shares do fall. Now, anytime any unexpected news hits and the shares fall, I always do a completely new analysis before investing any new money in, and only if I still come out with that strong upside opinion on the stock. Nation, it is so important here to honestly listen to that other side of the story, the bear case for why the stock is falling. And too many investors just get cemented in their analysis, and even when that new information comes out, they only read articles that put a positive spin on the stock, or that maybe they'll write off negative analysts as not knowing the true value. It's just a well-known behavioral problem called confirmation bias, and it has lost investors billions of dollars. There are other stocks not on this list, stocks that I did buy, I was wrong about it, and sold even at a loss because I took the time to look at that bear case and the new information when it came out. Nation, it is perfectly fine to take a loss on a stock if it means avoiding that bigger loss or just sitting on dead money for years because you got emotional about it and that investment and couldn't hear the other side of the story. I want to get back to that list of stocks to buy though, but stick around because next I'm going to reveal the one thing that can destroy your portfolio investing in stocks. Teva Pharmaceuticals, ticker TEVA, is one that I've owned for more than a year now and a strong value stock candidate. Not only is the company the world's largest maker of generic drugs, it also has a strong pipeline of branded medications along with blockbusters like Ajovy and Austedo contributing to $16 billion in annual sales. Now, shares initially plunged in 2019 on the company's aggressive acquisition strategy, borrowing tens of billions to buy other drug makers. Now, those acquisitions failed to produce the kind of sales expected, and the company was stuck with as much as $34 billion in debt. It's since paid that down to about $23 billion, which is still pretty high, but is manageable. Watching for that acquisition strategy is something we've talked about here on the channel before, and it has destroyed so much value for a lot of great companies like Teva and AT&T. I saw the turnaround from the strategy after that share price crash in 2019 and started building a position at that point, and what a ride it's been. This stock has rebounded back over $12 each multiple times, only to fall back below $8 a share. The other factor here in the stock's weakness is the 6-year litigation over opioid sales in the United States, with thousands of states' attorneys generals and local governments filing lawsuits against these pharmaceutical companies. And the majority of these lawsuits have now been settled, and Teva's CEO recently commented in their earnings release that the company's remaining lawsuits could reach closure this year. Now, Teva has over $2 billion in balance sheet cash and plenty of cash flow to pay a settlement without any fear of bankruptcy. So my perspective here in this one is not necessarily a growth stock like the last one, but a deep value stock with significant catalysts to the upside. The shares trade for a price to sales ratio of just 0.52 times versus 3.3 times multiple for shares of Gilead Sciences, that's ticker GILD, and a 3.6 times sales for Bristol Myers Squibb, ticker BMY. Now, for companies with so much debt, you really need to be using the enterprise value to sales ratio, which takes into account a lot of the balance sheet stuff like balance sheet cash and debt. But here we see that Teva stock is also trading at a huge discount here for an enterprise value of just 1.88 times its annual sales versus 3.4 times for Gilead and 3.85 times for Bristol Myers. So the average multiples for these competitors then would be something like 3 times sales or an enterprise value of 3.6 times sales, which would mean a share price between $33 to $44 each for Teva. Now, I do think that even after the opioid settlement, there's still going to be some overhang on the stock, especially with so much debt. So it might not get up that high, but this stock should still easily trade for 1 time sales or 2.5 times on that EV to sales basis, would mean a stock price between $15 to $17.50 each. I originally bought in after that 2019 collapse, but because the shares have been so volatile, I've been selling call options each year when the stock gets up around $12 each. You can see here, I've now got 6,000 shares at an average cost of $7.88 each, just over 47,000 invested. I sold 20 call option contracts last year, covering 2,000 shares when the stock reached back up to $10 each, and collected $1,800 to take some of the cash risk out of that position. Now, I also did the same the year before and collected nearly $10,000 on those call options, so maintaining that upside return to $12 or $15 per share and creating cash flow from a volatile stock. Now, I know that might be a little confusing at first, so I've got a video on options investing and how to use that strategy that I'll link to in the description below. Make sure you check that out. We've still got 5 more stocks to watch, including one that I've got over $70,000 in that could double my money, but I want to get your input on this as well. What is your top stock right now? In which stock do you have the most conviction, and why though? So scroll down and let me know in the comments below. Don't forget the why part though. Why are you buying that one stock above all the rest? Teladoc Health, ticker TDOC, is one of my 3 favorite growth stocks and probably the one I think could surprise the most over the next decade. Teladoc is the global leader in virtual healthcare with a provider network that covers 76 million US patients and a billion member data points from traditional telehealth to remote monitoring and even next generation primary care. And now obviously the last 2 years were huge here, like 5 years of growth all in one, but the company was already growing at a solid rate before that. Membership growth has grown 33% annually since 2018, and the company booked nearly 15 million patient visits last year. Revenue also doubled last year, and 80% of that is from recurring services, so I like this one for that stability, even if the growth from telehealth sales slows down from the pandemic pace. And longer term, telehealth and that virtual care is going to be the future, but I think the data is really that undiscovered value here, processing all those patient data points for analysis and research. And where, just last year, Teladoc was the poster child for those expensive growth stocks, the sell-off has taken this one into some really attractive value territory. Through increased monetization and modest member growth each year, management has a 3-year target for 25 to 30% annual revenue growth. Now that takes this stock to over $4 billion in revenue by 2024 on estimates for $2.6 billion this year. Shares of Teladoc are now trading for just 4.2 times on that price to sales basis. This is a stock that at one point traded for 17 times its sales and well over $300 a share, now under $70 each and still growing by 30% a year. Even on a very conservative price multiple of just 5 times its 2024 sales target of that $4 billion, that's a $20 billion company for a 112% price return to $146 per share. I gotta be honest with you folks, I hated the valuation last January, but I still really liked the company. So what did I do? I broke my own rule of never investing in a stock valued at more than 10 times on a price to sales basis, even a growth stock like this. But I compromised. By selling a put option for 100 shares at a $200 strike, I collected $42.50 a share. Now, what that means is that I collected that $42.50 in cash from another investor and then committed to buying their shares from them for $200 each by January 2023. That's the expiration date on the put options there. And shares were trading at $264 each at that time, so there were 2 scenarios here, really. If the stock did stay above $200 by 2023, then I kept that $42.50 collected and didn't have to buy the shares. Now, if, however, the stock did fall below $200 of strike price, I would buy those 100 shares for that much and keep the $42.50 each, which means my actual cost for the stock would be around $160 each. So, that was still a 40% discount to the price at the time. So I felt like even if the stock did come down from those ridiculously high valuations, I could feel comfortable buying it for $140 on that long-term analysis. Now, of course, we all know what happened. Shares have crashed even further, and I actually did pick up another 200 shares at an average cost of $70 each in January and February of this year. So all told here, my average cost for all 300 shares is going to be $98 each for a total investment of about $29,400 though that I think could easily be worth over $44,000 over the next few years. This next stock is by far my largest position at over $75,000, and And a lot of you are going to groan when you see it, but hear me out because this is the single biggest mispriced stock in the stock market right now. Groupon, ticker GRPN, emerged quickly as the first mover in the daily deals market for local businesses and used to be the hottest thing just a decade ago. But the company has struggled with its acquisitions and just that trend to e-commerce versus its traditional local retailers that it works with. So sales were already kind of weak and falling, but then just got crushed in the pandemic, falling to just over $1 billion in the last 12 months. And the company makes between 30 and 35% on the deals it sells, which is a strong take rate, but you can't make anything if people aren't going to be able to get out to get those deals. One of the things I like here, though, you see here in this 2018 through 2020 period, even on revenue as high as $2.6 billion, the company still wasn't able to turn a profit. Net income slid into negative territory, but on a massive restructuring, lowering costs across the board, Groupon has been able to produce positive earnings on just $1.1 billion in sales over the last year. So Groupon discontinued some of its non-performing segments last year, including its physical goods store, so it's really getting back to that core advantage in advertising. And from there are so many catalysts for this stock to just jump higher, from a valuation standpoint, even to a potential acquisition. And first here, I want to look at the balance sheet. And bear with me here because I know this isn't the fun part, but just a little bit of math here is going to show you why I say this is the single biggest mispriced stock in the market. Groupon has $499 million in cash sitting on its balance sheet and only owes $223 million in long-term debt. So that is a net cash position of $276 million. And remember, we're talking about a company with a total shares priced for only $559 million in the market. So 50% of the stock market valuation of this company is backed by cash. But hold on, because this is where it really gets crazy. Groupon recently revealed that it had a 2.4% investment in UK Fintech's payment company SumUp. This is a private company, but just closed a funding round that values it at over $20 billion. Now, these kinds of investments in private companies are nothing new. Google and Amazon both have billions, tens of billions of dollars in startups, hoping to one day buy out the rest of the company if it grows or just cash out on that investment. Now, the problem is, until a cash out opportunity like the company going public or just being acquired, it's really hard to know how much that investment is worth. But here, let's just say conservatively, okay, Groupon's 2.4% investment in SumUp is worth $420 million. Now that's 2.4% times a valuation of just $17.5 billion for SumUp, which again is below that current valuation, but I want to use just some conservative numbers here to show you this worst case scenario for the stock. We already saw how Groupon has net cash of $276 million just sitting there on the balance sheet. If then we add this $420 million from SumUp investment, that would mean Groupon could have cash of $696 million. Folks, the total value of the shares right now is just $560 million. So just on Groupon's cash and that investment alone, their shares should be worth $23.34 each. And that doesn't even include the value of the actual business churning out $1 billion in sales each year. Besides just that base valuation upside, there are several business catalysts for this stock that I think could take it even higher. The first catalyst would be a new deal with Google announced just last year. So starting in January, Google Pay users would be able to access Groupon deals, helping connect small businesses and customers and really streamlining how the users pay for those deals. Shares of Groupon spiked almost 10% on the news, but I think the market is still underestimating that boost to sales. Another catalyst here, and admittedly this one might take a little bit longer to pan out, but a potential acquisition interest from companies like Amazon or Google is always a possibility. And Groupon just still has a great competitive advantage in that local retail market, something that would complement a digital advertiser like Amazon or Google. Now, we already know Amazon is trying to work its way through those physical retail stores. This would seal the deal and make it the king of retail. Groupon's new CEO took over just a few months ago after heading up Zappos, an online retailer that was acquired by Amazon in 2009. So he not only knows how e-commerce works, but what Amazon is looking for in a company. But it's not just Amazon or Google that might want to acquire Groupon. After a year of being locked down, people want to get out and spend their money. And that's going to drive those traditional retail sales and prove that brick and mortar stores just aren't dead. So Groupon's position for that advertising in this part of the market can still be a great addition to an e-commerce advertising strategy, and shares are trading at that deep deep discount. But just for those two giant e-commerce leaders, it makes a ton of sense of why Amazon or Google would want to buy Groupon. And part of Groupon's problem is that it hasn't been able to build up that distribution to reach enough customers or businesses, but fold it into the billions of people visiting Amazon each month and you would see sales skyrocket. But I believe even without that acquisition offer, these shares should be worth at least $30 each. That's less than $200 billion for the entire business, creating $1 billion in annual sales, plus the cash and the sum up investment. It's a 60% return from here, and realistically, the stock could even get to as high as $40 or $50 a share. I started buying the shares in March of 2020, just after that pandemic crash just destroyed the shares, and have added to the position since with most of it, about 2,500 shares of these 4,000 shares this year. My cost basis here is $23.31 a share for $75,000 invested, and you see here, I'm using that same covered call strategy that I used with Tiva. When the shares popped higher, like they did in January, jumping 38% in 2 days to $30 each, I sold these covered call options and collected almost $13,000 in cash. And here I still have that upside return to $30 a share in 1,000 shares and to $40 a share in another 1,000 shares beyond that. So putting this together, if shares of Groupon go to just $30 each, something I think is easily possible after they monetize that sum up investment, I will make $50,000 on this one stock alone. Now we'll get back to that list of stocks to buy, but Nation, I need to make a very important point here. Even at that $75,000 investment, Groupon isn't breaking my 5 to 7% rule here. In fact, it's closer to about 2% of my total portfolio. Now, all you out there in the Bowtie Nation have heard me talk about this, but let me explain because this is so important when we're talking about chasing these deep value stocks. These 7 stocks I'm buying all seem like great investments, but there is a good chance that at least one won't meet my expectations and may even fall further. And Nation, I've just seen too many times, too many investors get emotional about a stock, keep on buying it all the way down and just lose so much money. And what happens here is they buy in at $100 a share, then at $80, and then $60 and $50, and just keep on buying until that one stock is like 30 or 40% of their portfolio or even more. I've seen investors chase a stock and eventually have all their money in that one single company. And folks, I know it's easy to get emotional about a stock, to have invested so much of not just your money, but your time analyzing it that you practically feel it in your bones that it's gonna rebound. It has to rebound. But if it never does, and you've got everything riding on this one stock, that's the kind of thing that just destroys portfolios and utterly devastates investors. This is why I always say, even if you're adding more into a stock, just buying more shares on that dollar cost average strategy, never have more than 5 to 7% of your total net wealth in a single stock. That way, if the stock does jump back, great, then you still made a great return. But if it sits there dead money or worse, or if it never recovers, you're not going to wreck your entire financial dreams. This next stock I'm buying, WW International, ticker WW, is another short-term value play here on a steep discount in these shares. So over the last year, I've been looking for these stocks, these kind of stocks that have just sold off wildly on the pandemic, but are still good businesses and should rebound once we get back to some kind of normal. It's stocks like Groupon and this Weight Watchers International. Now, for its part, Weight Watchers is transitioning to a more full-service health company, adding functionalities like sleep tracking, meditation, social media, and fitness to its mobile app. It's also in the middle of a turnaround, closing half of its US studio locations and really shifting to more of that digital-first model to cut its expenses. But if people aren't going outside, they don't care how big their asses get, so sales and earnings have been hit over the past couple of years. Sales of $1.2 billion over the last year were down 14% from $1.4 billion in 2019, and both sales and earnings are still expected flat for 2022. But here, for a stock down 75% from last year's high of $41 a share, there is still a lot to like about this company. The fourth quarter was likely a low point for subscribers, and this is cyclically the worst quarter for the company. I think the first and the second quarter this year could get a boost from people emerging from their pandemic caves and just trying to get back into shape. This is still a strong cash flow business, generating $157 million in operational cash flow last year and $120 million in free cash flow. The company has over 150 million in balance sheet cash, so plenty of funds to see it through this transition, and earnings are expected up 20% over the next couple of years as it trims those expenses. But like with Tiva, it's really on the valuation side that I'm investing. The shares trade for just 0.57 times on that price to sales basis right now, which they were as high as 2.4 times sales in 2017. Now the 5-year average price multiple of 1.8 times sales, that alone would be 215% increase in the stock price, and any improvement in the outlook gets the stock to at least $20 a share pretty quickly. I've been buying since after the big drop in September of last year and have added another 1,500 shares this year on an average cost of $16 a share and almost $31,000 invested. Now, like Tiva again and Groupon here, this isn't necessarily that long-term hold like with those growth stocks in the list, but a valuation play on a stock that is just too cheap to stay at this price. Another growth stock I really like here, one positioned to be the future of banking, PayPal Holdings, ticker PYPL. I recently did a complete analysis video on PayPal and think it could go to over $500 a share for a 377% return from here. I'm going to summarize that valuation here, but look for that video linked in the description below. Now, PayPal is quickly becoming everything you need in digital finance. It enables retailer payments through its Braintree acquisition, allows you to send money internationally with Zoom, helps people with savings and couponing with its Honey app. It offers bill pay and direct deposit, as well as even a high-yield savings account with its partnership with Synchrony. And then bringing all this together with the Venmo digital wallet, and you could conceivably handle every financial transaction through the PayPal ecosystem. And that's really a bigger opportunity than the market realizes just yet. Use of digital wallets passed cash last year in offline sales and have been the dominant payment form in e-commerce since 2017. You see the rise of digital wallets in the purple line here in these two charts, e-commerce on the left and then offline point of sales volume on the right. Digital wallets are now used in 45% of all e-commerce purchases and nearly 1 in 3 offline purchases. That trend in digital banking and handling all your money in zeros and ones instead of dollar bills, it's only going to pick up momentum, and PayPal is the undeniable leader in this space. A survey last year found that 60% of Americans now use some type of digital wallet, and it's interesting here that in this table you see both PayPal and Venmo, so since PayPal owns Venmo, really it's 32% using PayPal, well above the usage of any competing wallets from Google or Apple. Now I'm going to come back to that upside potential on the trend, but you can already see the momentum here in its growth. Revenue has grown at an 18% annual pace over the last 3 years to $25.4 billion last year. Here with management's target of 20% revenue growth over the next few years, the company gets to that $43.9 billion in sales through 2024. Analysts actually expect this a little less, maybe 18% annual growth to $41.9 billion, so I'm going to use a range of estimates when I look at the valuation on the stock. So here I've taken the revenue growth estimates and the price to sales ratio just to do a quick back of the envelope price target for PayPal. You see 3 estimates here for revenue growth across the top, from 17% to 22% over the next 3 years. Now remember, management is targeting 20% annualized growth, so that would be about $44 billion, and in the middle column here. Then on the left side, we're using this price to sales ratio to estimate what the stock price would be given those different revenue targets. Remember, right now, PayPal is trading for a price of 5.4 times its sales. I think this is the point of max fear, so I'm going to use that as our bear case scenario. Even that, though, produces a share price target of $195 to $221 over the next 3 years. Now, I think more realistic, though, is that investor sentiment does improve on PayPal and the price multiple comes up to at least 6.5 times on that price to sales ratio, and maybe even to the 7.5 times price. A price to sales ratio of 6.5 times, though, and then management's estimate for 20% sales growth would mean a stock price of $245 in the next 3 years, and I've done the calculation for annual return on the right. That price of $245 a share in the next 3 years would mean you make nearly 30% return each year. And you see here, though, even this bear case scenario, the worst outcome with that 5.5 times price to sales ratio and the 17.5 sales growth, that produces an annualized 20% return. Now, the potential for a 30% annualized return to $245 a share, that doesn't even include the big upside on that rise in digital wallets that I outlined in that recent analysis, so make sure you check out that video. Just on this near-term $245 price target, though, I've been buying shares since January of this year for a total of 400 shares at an average cost of $140 each, or just under $45,000 invested in this stock. Now, this next one is more of a strategy than a single stock, but could mean a 53% return in less than a year, with covered calls on the ProShares Bitcoin Strategy ETF, ticker BITO. Now, I know a lot of you out there aren't yet Bitcoin believers, but hear me out on this one because it's a great way to use that volatility in cryptocurrencies to your advantage for some great cash flow. Now, we've already talked a little bit about that covered call strategy, and I'll link to that video in the description, but I just want to walk you through here what I've set up. This is one of my other accounts, and you see I've got over $30,000 invested in 1,200 shares of the BITO fund. I bought the shares for $25.19 each, and then immediately sold these call options to another investor, collecting $5.56 for each share. I collected a total of $6,675 for all those call options. Now, there's two ways you can actually look at this investment, but either way is going to blow your mind on the return. One way is as a discount to those shares. And because I collected that $5.56 a share on the covered call options, that lowered my cost of the fund to $19.62 each. That means if I got the fund at a 22% discount to the price it was trading on for that day. If the fund goes to that $30 each by expiration of those call options, so January 2023, and I would sell them for $30 each and will have made 53% return on my money in less than a year. If, on the other hand, the shares stay below $30 each, the calls expire worthless. I keep the money collected and the shares and can just turn around and sell more call options against them for even more cash flow. The other way you can look at this, though, is as an instant cash return, basically making the BITO fund an amazingly high dividend stock. I paid $25.19 for each share and immediately collected that cash return of $5.56 each for a 22% dividend yield. And same scenarios apply here. If the shares move to that $30 or more by the expiration, I'm going to sell for that amount and make the difference between that $30 and the $25 I paid, or about 19% on top of that dividend yield. If the shares, though, close below the $30 by January, I sell another call for another dividend. Check out the videos linked in the description below, or click on the video to the right for how to invest $1,000 in a dividend portfolio, a complete 7-stock portfolio that pays you almost 6 times the dividend yield of the overall market. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.